In the meantime, let's go to our featured guest of the morning. He's Dennis Mitchell, Chief Executive Officer and Chief Investment Officer at Starlight Capital. Welcome, Dennis. Great to have you, as always, on our show.
Thanks, Paul.
Let's begin with the Fed. We will not get dot plot predictions from the Fed today, but we will get an announcement and a press conference. What will you be watching for? What do you expect the tone to be?
Right. So at this meeting, you're expecting a balance between we are going to be cutting rates later this year, but we don't need to start now. It's not imminent. You shouldn't expect 100 beeps out of the gate. So it's a balancing act between acknowledging what they've already guided towards and not getting the market too excited and ahead of itself.
The market is saying it's a 50-50 a coin flip situation as far as a rate cut goes on March the 20th. And Jerome Powell is expected to push back his expectation. Would you expect that?
Yeah, I would expect him to push back. And part of the challenge today for him is to push back firmly without inducing panic in the market, right? March is pretty much off of the table based on the GDP numbers that we saw in Q3 and Q4 of last year for the United States. Again, I think the challenge that they have, though, is that they were behind the curve coming out of the pandemic. And so sooner or later, the market is going to start taking the opposite opinion, right? You're going to be behind the curve and you're going to miss it. We're going to go into recession.
Right.
So that is really the challenge for him. But yeah, we're not going to get a rate cut in March. The commencement of an easing cycle will coincide with a meeting that has a press conference,
right,
so they can firmly explain the plan going forward.
Right. How many rate cuts do you expect this year from the Fed, and amounting to a total decrease of what?
So historically, to stave off recession, or when you've hit recession, you get about 500 basis points of rate cuts. That's not going to happen this time around. So you can expect about 250, 200 to 300 this cycle. How many happens this year is kind of irrelevant, but between 2 and 4. But over this next rate cut cycle, you will get between 200 and 300 basis points, assuming that we don't deteriorate further.
Okay, let's move to the other big market story of the day, tech earnings. We'll take a look at what you might call the headline numbers on all three. These are the earnings per share numbers, and it would surprise a lot of people to see these numbers and then see the stocks down fairly significantly in at least 2 of the 3 cases in reaction. There's Microsoft clearly beating earnings per share expectations, Alphabet clearly beating earnings per share expectations, and Advanced Micro Devices meeting those expectations. This looks like a case of perhaps excessive expectations being built into the market. All 3 of these shares are at or very, very close to their highest share prices ever. Artificial intelligence is what has investors excited about all 3 stocks, and the narrative coming out of this appears to be that none of these companies gave forward-looking guidance that was as robust as the market was expecting, particularly on AI. At Microsoft, revenue rose 18% to $62 million. Azure cloud services sales, cloud computing sales, rose by 30%. But the company appeared not to give a forecast, including AI, that was as robust as the market had wanted. In the case of Alphabet, the story is that revenue from its core search advertising business fell short of estimates, even though overall revenue grew by the most in 7 quarters. So that is the complaint, quote unquote, of investors with the results on Alphabet. And in the case of Advanced Micro Devices, its revenue forecast was perceived as weak, even as the chip maker predicted that new AI processors would generate more money than expected last year. So in the case of Advanced Micro, the AI forecast was robust. The overall revenue forecast appeared to be a disappointment. The company said that $5.4 billion would be first quarter, $5.4 billion US would be its first quarter revenue. That was light of the roughly $5.8 billion expected by analysts. We will have Mandeep Singh with us shortly after 8:30 a.m. Eastern Time to dig further into these numbers and the market reaction. Dennis Mitchell, any thoughts on your part on these 3 tech bellwethers?
Yeah, and so I'm not surprised by the market reaction. Right now, the S&P 500 is pricing in about 11% earnings per share growth for this year. So every year at this time, we're high on the estimates, and then as the year unfolds, we come down almost in a stepwise fashion. I would expect earnings per share this year to be closer to about 6%, the global average that is forecasted. So you can expect U.S. earnings to come in and, companies don't usually cut employees and cut back on capex and then announce, forward guidance that's increased. So people shouldn't be surprised that if we're laying people off in the U.S. and cutting back on capex, that top-line revenue growth forecasts are not what the market is expected.